Now we'll look at using crypto wallets and some of the security implications of buying crypto. Because if you buy crypto, you'll either do so on an exchange, and so you're giving the exchange custody of your assets, or you withdraw them into self-custody. Now, there are Bitcoin ETFs, as of making this video, which means that you can just buy the ETF, which is an exchange-traded fund, where basically, well, the way it works right now is that Coinbase is the custodian. So Coinbase custodies all of the assets for the ETF providers. The ETF providers have the assets. The exchange traded fund is something that you buy in your stock brokerage account. You just have the ETF. You get price exposure to Bitcoin, but you don't own Bitcoin. You can't use it. You can't do anything with it. You just get price exposure. That's obviously custodied for you, but you have trustworthy institutions doing this. So if you want to take self-custody of your assets and actually use them, how do we do that? Because you can get price exposure through an ETF, but you can't use it, right? You can't send it to someone. So it's different. So wallets are, of course, the thing that we use with blockchains to take self-custody. Wallets let us access crypto accounts. Crypto is cloud-based money, and so the money is always on the blockchain. It never goes into your wallet. It is not a data packet or a thing that goes into your wallet or your application or anything. It's all on the blockchain. You just have access to an account. So that's what the wallet is. It's basically an account that sees the assets that you have in that account in the cloud, which is the blockchain. You never own or hold any crypto ever. No crypto is in your wallet. No code representing crypto is on your device. Wallets, what they do is they hold keys to spend the crypto associated with the account. So you open an account and you get keys. It's like a password. Anyone who has that password can spend the crypto in that account. If you know the keys to a wallet, the wallet is yours. Anyone who knows the keys has access to that wallet and can spend them. Crypto is therefore a bearer asset. If you have keys to a wallet, you own it. If you have someone else's keys to their wallet, you own their money. Because it's a bearer asset, you have their keys. You can open a wallet account, open a wallet app, put in the keys, have access to their crypto. It's like an email account, right? So you have a wallet address that is the email address, and you have the keys, which is the password to spend the money. A wallet is not an app that you use. The apps that we use, like Trust Wallet or the other wallets out there, these are interfaces. These just let us access the wallet, which we created on the chain, and they give us an interface that we can use. This is how you set up a wallet. You go to a wallet provider. Now, I've got videos on best wallets and things like that, which I'll link below as well. Some links to the wallets that I use as well, I'll link down below. But you go to a wallet provider and you open a wallet. That wallet provider will help you open a wallet on that blockchain. You then get an account. That's step 2. In step 2, the wallet application that you're using helps you open an account. You get a public key, which is your email address. You can't choose this, it's just given to you. So that's your email address where people can send you crypto. You also, within that application, get the private key. That's like the password to your email account. The application that you use keeps that private key in the app. And of course, that's the thing you need to spend crypto out of the app. So the third thing that you get that you actually see is a seed phrase. Seed phrase is linked to the private key. The seed phrase is a human readable list of words, around 12 to 24 words. The private key is like gobbledygook, right? It's like this. And so you don't want to write that down. So the way that we write it down and have a kind of offline way to recover the wallet is the seed phrase. This is what the seed phrase looks like. It's literally 12 human readable words. You write them down in order, and that is your wallet. So what happens is, when you get the application, what happens if you lose your phone? Well, you don't lose your money because your money's in the cloud. It's on the blockchain. Well, how do you recover that wallet? You recover it with the seed phrase. So you write the 12 words down on a piece of paper, Then you download the application again on a different device and it says, do you want to recover your wallet? You say yes. It says, what are your 12 words? You write these 12 words in. And it says, you own this wallet because you have those words. And it brings up all of the balances you had in your wallet. So this is like a master key. The issue with this is that we're in the digital age, we're using cryptocurrencies and money in the cloud, and we're writing down 12 words on a bit of paper, which is obviously ridiculous. There are other ways to do this. You can buy steel seed phrase cards, which are a card or like a tube where you can have steel and you kind of put the words in steel and you close it up and stuff. Still ridiculous. This should be digital. So there's actually two things that we need to worry about with wallets. Where is the private key stored? And how is the seed phrase stored? They're the two things we need to worry about when we're choosing a wallet. So these are the different types of wallets that we can use. Software wallets, hardware wallets, and NPC wallets. There are others as well. There are paper wallets where you write down the private key on a piece of paper. So they've really been phased out because they're obviously awful in terms of the use case. But these are what most people use now. So all of these wallets, what they're trying to do is, where do you store the private key and what is the seed phrase backup? There are two things that are different amongst all wallets. Software wallets, otherwise known as hot wallets, these are an application that you download. These are completely free. Trust Wallet is great on your smartphone, MetaMask, many others. I'll leave links below to the tutorial videos on exactly how to set them up and use them and what they're like. Free to use, phone, browser, you get a wallet and then you can receive crypto. The downside is that the private key is kept on the device. So it's on your phone or it's on your browser. Could get hacked, you could get a keylogger. It's not very safe because it's online. So if a virus comes in, it can take your private key. And remember, if something has your private key, it owns your money. That's where hardware wallets come in. Hardware wallets are special physical devices like a USB stick or a smartphone thing, whatever. And what they do is they create your private key on that device only. And it's not on your computer or on your phone. It keeps the private key on that device. These cost money. And they're annoying to use because it's a hardware thing. So if you want to spend coins from your wallet, you need the hardware device with you. You need to then plug it into your computer to spend coins if you want to send them somewhere. It's a little bit worse, but it's a lot safer because the private key is offline all of the time unless you want to spend the coins. You also have to physically accept spending coins on the device, and the device can be set up behind a PIN number or a fingerprint scanner. So the private key is much safer because it's offline. So that's great. The downside here with hardware wallets is that the seed phrase is also something that you have to write down offline. So this one here, the seed phrase, you have to write down on a piece of paper. But the private key is online. This one, the private key is offline, but you have to write the seed phrase on a piece of paper. So you're in the digital age, you've got a hardware wallet and a piece of paper, and if you lose that piece of paper, all your money's gone. Because if you lose that hardware device, or you can't access it, or it breaks, and you don't have your seed phrase back up, no one can recover the wallet for you. Not great. The next option is MPC, which is known as multi-party computation. This attempts to split up the private key and the seed phrase amongst different parties and encrypt it. It's all digital. So what happens here is that these are applications that you download. So for right now, as of making this video, Binance and OKX have Web3 wallets with MPC, but there are other separate providers as well. And so what you do is you set up an account with the MPC provider. You give them some sort of login, like an email address. So they need an account to associate with you. The private key gets split up into 3 shares. The wallet provider has one. You hold one in your iCloud account. And the other is 2 of these, usually 1 and 2. And this is on your phone. So your phone can spend the crypto out of the wallet because it has 1 and 2. So you log in with the wallet. It knows who you are because you have that login with your email address through 1. And on 2, you have the second bit of the private key. Of course, you need 2/3 of the key to control the wallet. The wallet provider doesn't ever have 2/3, they only have 1/3, and so they have no control over the wallet. The private key is also encrypted and sharded, meaning that they don't even know what it is. They just know that it's associated with your account. They also know through cryptography that this second share is linked to it. And so when you put 1 and 2 together, it lets you spend the coins from the wallet. The third is in your iCloud or your Google Cloud and also encrypted and hashed. This is for recovery, so that if you lose your device, you can go back and get your cloud account open on a different device, download this. 1 and 3 together makes 2/3, which can get the wallet back on your device in a fresh number 2. You never expose your crypto to 1 because everything is hashed. And so it just knows that 3 and 1 are linked in some way, but you're not exposing the key. Also important is that your private key actually never gets exposed. It is encrypted and hashed. And so even when you're spending coins, you're not exposing your private key, which means you're not technically keeping your private key on your device. This is a digital way to try and get around the private key and the seed phrase problem. So with MPC, all you need is to remember is your iCloud account login, because you need to be logged into that. And then you set up a password with this, or a PIN number. So that's all you need to remember. You don't need to remember 12 words, you don't need to write it down if you don't want, you just need to remember that password that you set up. This is trying to make seed phrases and private keys a little bit safer. It's coming into more and more use in the crypto industry, but these may be useful for you as well, because these are self-sovereign without any accounts. And certainly for this one, for the hardware wallet, there's no digital signature if you don't want there to be. Here's an infographic of the pros and cons of these hardware wallets. So I'll just get out of the way so that you can see this. MPC really is more or less great for every option. Software wallets, you can really just use MPC at this point if you want. Hardware still have an advantage of no digital signature or no digital account. They do cost a little bit of money. Here is hot cold versus MPC. Again, you can read this, I don't want to go through this, but you can just see this and screenshot this in terms of pros and cons. And then what I want to talk about is, do you need to use a wallet? Is it best for you? Or should you just let someone else deal with it? Self-custody is self-sovereignty. You have ownership of the asset. That's the entire point of crypto. The reason why Bitcoin was invented is when all the banks went bankrupt and everyone was bailed into the banks, meaning you can't take your money out. Sorry, your money isn't yours. With crypto, it is yours if you take self-custody with it. They can't do that. But if it's custodied somewhere, you're at risk. You have to balance that risk if it's big or not. Now, banks are different to asset custodians. Banks do not keep your money. They leverage out your money, they lend it out, they do not have your money there. That balance in your bank account, not there. Banks are levered 9-1. Your money is not there. If everyone wanted to draw their money out of the bank at once, the thing is literally bankrupt. It's insolvent. Asset providers are different. Asset providers like Coinbase and Binance and ETF providers, these are not banks. They hold assets one for one for clients. So it's very different than a bank. Asset providers are not banks. They should be holding one for one. FTX didn't, but the other crypto exchanges have proof of reserves that show one for one backing. Asset providers are not banks, they're different. It's different risks, but there are still risks. With self-custody, everything is on you. You are responsible for keeping that seed phrase and private key safe, and you have to have that in your mind, and you have to keep up with it to make sure that you're not going to get hacked or lose anything. If you have self-custody, do your family know about that? In an inheritance scenario, can they access that crypto? Or is your seed phrase buried in the garden and they don't know it's there? And you've got $10 million on there, and that's their inheritance and you're gone and they're broke and they can't get your money. So that is something to be aware of as well, that you have to think about. Also, self-custody can be expensive because if you're buying Bitcoin, fees on the Bitcoin network are going higher as the network grows. You may have to pay $5, $7, $10 for a transaction during heavy times. If you're saving smaller amounts, $500 or something, that's a lot, right, to send out and back in. Plus, Bitcoin has UTXO problem, which is if you have many small UTXOs, each time that you spend the coins, you have to spend each of those UTXOs, which can add up if you're putting small amounts in. Essentially, it can become costly when you want to send out the assets. ETH is expensive to use, so if you've got $500 and you're drawing it to ETH and you're paying $15 for a fee for a blockchain, that's impossible, right? That's going to eat away so much at your investments that you shouldn't be using it at that point. So it can be really expensive, especially with smaller amounts, because these are just flat fees that you pay to the blockchain. That's where custody comes in. Now, if you're using Coinbase or BlackRock, these are professionals. They're not going to lose your crypto, and if they did, they're probably going to have to pay you insurance or just make it up themselves. So they're professionals using the highest quality, custodial solutions, right? Custody is mostly free. Like Coinbase, if you put money on Coinbase, free. You don't pay anything. Binance, free. For the ETFs, they might charge you 30 basis points a year as a fee to have, the custody there. Not the end of the world, right? If you're paying for custody and you haven't got that worry. They can be custodied specifically for the ETFs, for Bitcoin, and I'm sure others are coming. They can be put inside a tax wrapper, which you might not be able to do with the currency directly, especially if you're holding self-custody. All you need is a login and password for your Coinbase account or something, or your ETF brokerage account. It's right there. Inheritance isn't a problem because you can just say, hey, look, I've got a Vanguard account. They can recover it, no problem. Or, Fidelity. Fidelity are the good guys, really into crypto. So if you have an account with them, they supported with crypto. And the problem with custody, which we found out with FTX and others, is that if you have crypto on an exchange, you are actually an unsecured creditor of that exchange, which means that you are last in line to get your money out. And if the exchange has gone bust, you're not going to get much back. That's custody, so that's an issue. Now, proper professional asset managers, BNY Mellon, right, people like that, BlackRock, they're not going to be doing any of that stuff. They're going to be holding your assets in trust, separated from their business, and you should be able to get one for one back. But it's an issue, especially if you're using crypto exchanges where they're small or whatever. The thing is with custody is there's a lot of advantages. It's easy, it's cheap, but there are downsides as well. So self-custody or custody, there's no right answer. It's going to depend on you and where you see the balance of risk. One of the main innovations, though, of cryptocurrency is peer-to-peer value transfer. So we're not just buying these internet coins and hoping they go up in value. You can get things done on these blockchain networks, right? We can lend, we can borrow, we can trade, buy and sell. We don't have to use a centralized intermediary. What's the difference between CeFi and DeFi? Not much. DeFi are protocols. So it's a protocol and it's on the blockchain and there is code there that dictates the rules. We use it at our own risk, right? With centralized, they're doing all of that in the background, but they're just giving you a nice wrapper on top. You have to trust them that they're not going to steal your money or go insolvent. You don't have to do that with DeFi, but there still are major risks. DeFi protocols can have a bad debt, things can go wrong, hacks, scams. If you send money to the wrong wallet, your fault. If you click on a phishing link, your fault. No one's going to help you. There's many downsides of, using blockchains directly, but we can get things done on them as well. And these protocols, have opportunities. The only real difference between them is that on DeFi, there's no KYC, know your customer information. With CeFi, you need to give a driving license and everything like that. With crypto, we can just use things and we're just sending code around. This is how a blockchain works. You have a wallet with your money in it. You send the coin to another wallet, a small amount goes out in the blockchain fee. You have to pay a fee to the people. When you use a protocol like a dApp, decentralized app, lending, borrowing, trading, you send your money, you interact with the smart contract, which costs a fee. You pay a blockchain fee for that. You pay a fee to the exchange or something like that as well. So you may pay 3% as a trading fee or anything else. Or if you're lending money out, they may take 10% of your profits, something like that. You also pay a blockchain fee for every transaction. And then eventually it actually goes back into your same wallet, right? But you've paid those fees out. So dApps, applications, are businesses just like centralized exchanges, right? The only difference is they're on the blockchain in their code, and there's no one there making centralized kind of decisions about what's happening, right? You can do it any time of day, but these are not decentralized, right? There is a group of people writing the code and, making the application, upgrading the application and things like that. So it's not really decentralized, but it is permissionless, as in you can permissionlessly access it, and any time of day, you don't need KYC. That's pretty much the difference. So what we're going to do is use some applications to show you. So for right here, I have a blockchain that I want to use. I know that I want to use BNB chain. It's low cost, just for this example. So what do I need? If I'm going to use a blockchain, first thing I need is gas to pay for fees. BNB chain uses BNB coin as fees. So I'm going to go to Binance and buy BNB. Now what I need to do is send that out to a wallet. Many wallets you can use. You just need to make sure that the wallet accepts the coin and the blockchain that you want to use. So I'm going to show you MetaMask as an example. MetaMask is the wallet that a lot of people use for Ethereum, DeFi. So all of the EVM chains, Ethereum, BNB chain, Avalanche, Polygon, Optimism, Arbitrum. In fact, you can see all of these here. These are the list of all the chains. These are EVM chains, so they all use kind of the same code. And you can add them all in your wallet. These are different chains, so you have to make sure that you're using the chain that you want. I'm not going to go through setting up MetaMask here. I've got wallets videos below on recommended wallets, how to set them up, how to use them, so you can get into the details there. But we've got a wallet set up. And from here, this is a browser wallet. I know that it supports the chain that I want to use. So what I'm going to do is go onto the chain. This is the chain that I want to use. This is my address right here. So this is my wallet address that we need to give Binance because we're sending BNB out from them. So I'm going to copy this, go back to Binance. I've bought some BNB. I'm going to paste my address in here. This is my wallet address that we know that we want to receive the coins to. The network that I'm going to use, I know that I'm using BNB Smart Chain as a network. Because I'm receiving on that network, we need to send from that network. So the centralized exchange supports all the networks. And as long as the exchange is supported, they'll have some value there that they can send out to your wallet address. So as you can see here, this wallet address is actually supported on 2 different networks. These are both BNB networks. Which one do I want to choose? I know that I want to receive it on the BNB Smart Chain. So I send it from the BNB Smart Chain for my exchange. Yes, I'm sure that I can accept that. Now, the exchange knows the coin that I want to withdraw, the network that I want to receive it on, and the address of my wallet. That is the same for every network. Then I can choose an amount that I want to send out. So I'm going to withdraw whatever amount of BNB. I press withdraw. Just check the details so that you have the wallet address and the network that you're using. You can't receive on different networks. So if you're sending from Ethereum and you expect it on BNB, it's not going to show up. What you can do is go back to your wallet. And if you've used this address, this is an EVM address, which means it's the same address across all EVM networks, which are these ones here. If you sent from your Binance and you withdraw on Ethereum, it's going to be in your Ethereum account on the Ethereum blockchain. It's not going to be on the BNB Smart Chain. So what you're going to have to do is, well, firstly, you've sent the wrong coin, and secondly, you don't have ETH in your wallet because you need ETH for gas on the Ethereum network. So it's really important that you get the coin and the network that you want. I know BNB Smart Chain. So what I'm going to do is just withdraw this, and it will take 5 minutes. It will just send that out to my wallet. Actually, it will take more like 25 seconds. BNB Smart Chain is quite a fast chain. So you've now got a balance in your wallet of the gas coin. You always need the gas coin, and you need an amount in there to do anything to pay for gas. You can, of course, withdraw different assets from your Binance account. If you're looking to withdraw an asset built on top of the chain, like a stable coin, you can withdraw that to the same address. But in order to use that, you need gas. So you need the layer 1 coin at all times in your wallet. So we've got this amount here. So what can you do with money? You can trade it. So we'll do that. This is a decentralized exchange. PancakeSwap is decent. It's been around for a while. A lot of people use it. I'll link a video guide as well below if you want to use. The thing with DeFi is that anyone can create anything. So make sure you're going to the right URL for all of the DeFi apps that you use. I would star them or favorite them to make sure that you're going to the correct URL, because there can be fake ones. Connect your wallet to it, all your money's gone. Make sure you're going to the right place. I would double check as well on Twitter, on the Twitter account, the official Twitter account of each protocol, the URL that you're going to. From here, we need to connect our wallet. So I've got a wallet in my browser. I'm going to press Connect Wallet. I know I'm using MetaMask, so I'm going to click this. By the way, Rabby is a great wallet as well. Highly recommend it. It's great. But we'll choose MetaMask for this example. My MetaMask is now connected. You can see that. So my MetaMask is connected to this wallet. We want to make sure that we're on the right chain. You can see many chains are supported here. So I'm using BNB chain. If we go to Ethereum, it's going to switch to this network in my wallet. So switch, come out. Now you're on the Ethereum network. These are different. Different networks have different pools of liquidity, different amounts, different coins are traded. These are like banks, right? So one bank is separate to another. So one blockchain is separate. The fees are going to be different, more or less, and what's on offer is going to be different. So for me, we'll just switch back to BNB. And so I've got my wallet connected and I'm on the BNB chain, which is what I want to use. We're going to trade an asset here. So this is a decentralized exchange, so we'll go to trade and swap. From here, I know I have some BNB. So we're going to use BNB and we're going to swap it into Tether. Click on this one down here, switch to USDT. That's the asset that I want. So we're swapping BNB into USDT. What you can also do here is search a token via its token address. So right here is a list of tokens that PancakeSwap has, and these are tokens that it thinks are legitimate. You can see that USDT is listed on CoinGecko here, right? I've got USDT that I've already selected this one, so it knows that I've got it. But what happens if you're searching for some random meme coin or something? What you can do is go over to CoinGecko, see Tether here, we'll click this. Up in the right, it's going to give you the contract address of this token. So click these and you should see all of the different addresses. Now, each blockchain is different, and so it has a different contract address on each chain. We're going to search for BNB chain, wherever that may be, right, just wherever it is, and then you can go and copy that. You've now copied the contract address of this token. You can go back to the exchange, you can press paste, and it searches for the contract address. So you know that you're getting the real thing. CoinGecko is reliable, so you can search for it. This isn't found because I've copied the Ethereum address, and that's different to the address on the BNB Smart Chain. That's just a way to get some more valid token results if you can't find them through the search page. From here, I've got BNB, so I'm going to swap 25%, and I'm going to swap it into US dollar Tether. So that's here. It tells me what the exchange is. I'm going to press swap. So if you want to know exactly how to use PancakeSwap with the settings and everything, I'll leave that for that video. But we're going to swap, confirm. Now, if you haven't ever used a blockchain before, what these applications do is they have to ask for your permission to manipulate your account. What it's going to do is say, if you've never used USDT as a token before, it's going to say that you have to approve the application to manipulate this token in your account. And you're going to have to accept and sign a transaction that approves this token. So you have to go through that with that transaction. For me, I think I have it approved already. So I'm just going to update the price and press confirm swap. It's going to take me through to my wallet. It says these are the details of the swap and it's going to cost me 18 cents in gas. I'm going to press confirm and transaction submitted. You can add the token to your wallet on MetaMask or the others if you want to press that. You can see that the transaction has gone through and I've got a transaction receipt here. I can click this and it goes through to the Blockchain Explorer, which will give me every minute detail of the trade, the time, the timestamp, how much was done and everything, and the token addresses. But that's it. That's traded. So we've used a decentralized exchange to swap one asset for another. Now that I've got some Tether in my account, I can go and lend that out in DeFi as well. So on BNB Smart Chain, Venus is the lending protocol. Not saying that BNB is good or bad or anything. It's been around for a long time. It's fairly cheap, and so I just chose it for this example. But there are many other chains that are great and that work really well as well. You can find them all. So this is a lending protocol, so I'm going to connect my wallet. MetaMask should be connected. And then from here, it's going to identify the assets in my wallet. And so it should tell me that I have some Tether, because we've just swapped into some Tether. So what we can do, you go to the dashboard, you should be able to see what you've got. So you can see the wallet here. It shows me that I've got this amount of Tether in my wallet, right? 396 that we've just swapped. And so you've got for a lending protocol, you've got different ways to use it around the protocol. So I've got this Tether in my account. So what I'm going to do is go to the core pools. And then what we're going to do is go to the asset that we have, which is USDT. So I'm going to click this. And you can see that this is a lending protocol. So if you supply, you're going to be getting, at the moment, 7.44% yield. If you borrow, you have to pay 10% to borrow. And the spread in between is probably what Venus makes themselves, right? Plus probably some extra for potential liquidations and things like that may happen. This is a floating rate of interest, as you can see, so it's not fixed income, it's floating rate, which means that the yield can be anything dependent on supply and demand. But at the moment, it's 7.44%. So what we'd want to do here is go and supply. So it says supply, we've got USDT, so we'll click max. So we're putting this in. And you can see we're supplying at 7.44% APY. You're also getting an incentive from this protocol with their token called XVS. They're paying you a tiny amount as an incentive and extra. A lot of protocols do this to get you to use them, but obviously this is irrelevant because it's tiny. Total APY is 7.48, and we can approve USDT. So I've not approved for this app. This app does not have permission to use USDT from my wallet. So now I'm going to have to give them permission. So we'll approve first, approve USDT. Going to go through, we're going to have to sign this transaction, and it says, what is the spending cap? Custom spending cap is, just choose max. What this means is, I'm approving this protocol to manipulate $3.96 per transaction. That's the amount that I need. What I'm going to do is just change this to $100. And it says, be careful, do not give them access to all of your money. But $100 is fine, right? So I'm going to press next. I'm going to have to pay 4 cents for this transaction. 4 cents in dollars in cost, but that's an amount of BNB. But it just gives us a dollar amount. That's gone through. So now I can supply this token and actually use the smart contract. So I go through. This is going to cost me 24 cents. Press. And transaction completed. So what I'm doing now, well actually we're waiting for it up here, but what I'm doing is supplying dollars on a lending market, and I'm receiving 7.46% yield on the dollars that I'm lending out. Most protocols like this, where you have a balance and something that's happening in the protocol, give you a dashboard. For exchanges, they don't do that because you come in, exchange, out, and it's done. But obviously for a lending protocol, we have assets that are tied up here, right? And so you can see the summary of my account. My net APY is set 7.5%. My daily earnings are going to be tiny because I'm only supplying $4. Down here, you can see the summary of my account and all of my supplied assets. So I'm supplying this asset right here. So I can click on this, I can withdraw it, press max. This is the amount that I can withdraw, pay another transaction. So come through, you have to pay this, press confirm. That will withdraw that from the lending pool, and that will bring the tether back into your wallet, so it's not tied up anymore.